Well, good morning, everybody. We are just waiting for a few more seconds just to let everybody join. We've just passed 11 o'clock. It's lovely to have you all here this morning. I'll just give it a couple more seconds for people to join, and then we will start. Okay, well, I think we've got up to the number that we were expecting. So let's progress with the webinar. So good morning, everybody. We're here to talk about corporate reporting and governance, and in particular, the top 5 essentials for boards and audit committees for the 2021 year-end reporting. My name's Jessica Howard. I'm a director in the Accounting Technical Services team. And on your screen here today, we've been joined by 2 guest speakers from Mazars. We've got Anthony Carey. Anthony is a partner in Mazars and he's a senior advisor in board practice and public policy. And also Andrew Jones, who is a director in the narrative reporting part of the Accounting Technical Services team as well.
Good morning.
Hello.
If you have any questions, we're more than happy to take your questions. So please use the online chat facility within Zoom, and we'll incorporate your questions later on into the discussion. And also the final little bit of admin is that the session is being recorded, and it will be made available after the webinar today for you to listen back at your leisure if you so wish to. Now, before we dive into any more of the content, I'm actually going to hand you over to Lawrence Nye, who is Head of Policy at the QCA, because the webinar this morning, Mazars, we're holding it in conjunction with the QCA. So I'd like to hand over now to Lawrence, please, to say a few words.
Good morning, everybody. Thanks very much, Jessica. As you've already just heard, I'm Lawrence Nye. I'm Head of Policy at the QCA. I've been in post for just over a year, since October 2020, and I've spent most of my career sort of in the financial services policy space. So this section of looking after small and mid caps, what I'm here to tell you about is a bit more niche than some of the stuff I did at the Federation of Small Businesses, for example, but still a very important part of the economy. Next slide, please, Jessica. Thank you. And most of what I'll tell you today will be to sort of outline the importance of our small and mid caps. Here we show how they contribute 5% of the total UK tax take and employ 11% of the private sector employees in the country. So although it's not often thought about how much they contribute, they do make a massive economic and employment contribution to the country. Next slide, please, Jessica. Thank you. And I think what we want to get across and what we've been trying to make clear to government over the past 30 years since we've been established is that key point of not just how much we contribute to the economy, but how proportionality is a key part of how to make these companies thrive. So on the right here, we've got a graph which shows that the 100 biggest companies on our main market are such a small proportion of the actual total number of companies. There's a much bigger long tail of small and mid caps who need to be looked after, and we can't continue to design markets to just suit the large minority at the top end. This is another sort of illustration of the same point, but it brings in both the main market and AIM, and we reveal that over 48% are under 100 million, and 40% of those that are under 100 million are on the main market. So again, it's making that point that if we design markets for really large companies in the FTSE 100, FTSE 350, then we'll be missing out a huge chunk from the small and mid cap end that need to be looked after in terms of the rules they have to follow, in terms of the environment that is created for them to thrive as well. This slide just gives a sort of illustration. We've shown this to government on a couple of occasions. It's gone down better in some areas than in others. But the point we want to make here is that a small and mid-cap investor has a much bigger slice of the pie, so to speak, than an investor of the same amount in a much bigger company. And what this means is how governance and stewardship should be looked at for small and mid caps is quite different. If you've got a 10 million stake of a 200 million pound company, that leadership will immediately respond to any inquiries or any requests for meetings that you've got. So actually that relationship needs less of a heavy touch from government, and perhaps needs for investors to be more empowered to have those bespoke conversations with the leadership of the companies. Whereas at a much larger company, actually, perhaps it does suit that government has a bigger say in the governance and in the rules there. So we need more flexibility at the bottom end, not less. I'll quickly run through some of the work we've been doing over the last year in our policy team. One of the first things we looked at this year was the Lord Hill listing review, and that's it was a broad piece of work from which a lot of the other reviews came from. What followed on was things like the primary markets effectiveness review, the secondary capital raising review, and others, and all of those were designed to ensure that we sort of had a more welcoming environment on our market. So HMT has really led the way in that. It's been very positive, much of the work they've been doing. There's also been the changes to UK MiFID, which has been positive. And we've done some further work sort of with BEIS, trying to respond to their audit reform consultation. Some of that has been less positive. Some of the proposals we were quite worried about, but we did some research, surveyed our members, and hopefully put forward a good argument to avoid some of the more damaging proposals in the consultation. We're yet to have confirmation of BEIS's first take on their responses, but we're anticipating that will be very early in the new year. Other than that, we've done some research and prepared some guides for companies. So we produced the Good Jobs Come to Those That IPO report, which reveals how companies that enter the markets increase their employment soon after, how that funding supports employment growth at these companies. We also produced our broad performance review guide, which is possibly something many of you will be interested in today, and our practical guide to ESG, which we hope to build on in the new year as ESG becomes more and more of a key topic for companies to consider. Just to say thanks to Mazars for continuing to collaborate with us on this and many other things, and I will be on the call for the rest of the session. I doubt that I'll be as interesting to you as the other panelists, but please do shout in the chat if you have any questions. Otherwise, Merry Christmas to everyone, and thanks again for joining.
Great, thank you so much, Lawrence. So let's move on then to what our top 5 essentials are, and actually some of the points there that Lauren has just mentioned that the QCA have been working towards are actually part of our top 5 issues as well. So as you can see, here they are. Firstly, the first thing that I wanted to pick up as director of part of the Accounting Technical Services team, is the financial statements reporting impact, and particularly picking up on the key messages that are coming out of the Financial Reporting Council for this year, the FRC. Our second top essential area is the government white paper on restoring trust in audit and corporate governance. And then for our last three top 5 essential areas, these are all looking at the front end narrative reporting part of the annual report. So we're picking up here on risk reporting, climate reporting, and also the wider sustainability reporting. So I'm going to be talking you through the financial statement impact area, and then I'm going to be bringing in Anthony and Andrew to talk through the remaining 4 areas. This webinar is designed for boards and audit committees. We ran a series of webinars last week, which are much more detailed in relation to narrative reporting, IFRS and UK GAAP. They're available on our website. If you wanted to look into more of the detail, then please do look on our website for those. And throughout this webinar this morning, we will be referring to lots of documents and lots of reports, and we'll make available a single web page that has access to all of those links for you, make it nice and easy. So let's start off by looking at the first essential area in relation to financial statements. As you can see on your slide there, the FRC have been very, very busy this year producing an array of reports. The Key Matters report there for 2021, that's their annual letter that they designed to send out to directors and boards in relation to the areas of an overview of the key matters. So that document there is certainly worth a read for this year end. The other 4 reports that I wanted to pick up on are firstly the annual review of corporate reporting. Then there are 3 thematic reviews, firstly on viability and going concern, IS 37 provisions, contingent liabilities and contingent assets, and also alternative performance measures, APMs. The annual review of corporate reporting, as a reminder, this is the report that the FRC produce from their work that's carried out throughout the year. So they take a sample, I think it was just over 260 companies this year. They've predominantly are FTSE 100 companies, but they are wider FTSE 350 as well. And they look at their accounts, they raise questions, they ask where there are potentially shortcomings, where there's areas for improvements, and those reports that do good business reporting disclosure. So this report is very, very helpful and useful to be able to point you in certain directions of where you can improve your financial statements. So let's take a little bit more look into this first report. On your slide there, what you can see is it's the top 10 topic areas that the FRC found raised the most questions when they did their reviews. I'm going to be picking up on judgments and estimates, APMs and provisions later. But for this particular slide, I wanted just to pick up on 2 points. Firstly, the statement of cash flows, number 3 on the list of areas. And what the FRC's key messages here are that this was the key area of restatement that they found from the questions that they raised. So in particular, they raised questions about the classification of items within the cash flow statement. Have items been classified appropriately between operating, investing and financing? And also they found that on numerous occasions, companies reported non-cash items within the cash flow statement, whereas obviously the statement of cash flows is purely for cash flow items. So ultimately, the key message here is the statement of cash flows, it is a primary statement. I think sometimes it gets put to the back of the list on disclosures and what needs to be prepared and when. But it should be a priority, and it is an area that companies need to make sure they're compliant with IAS 7. And then the other area in relation to income taxes, particularly the area here that the FRC picked up on, is in relation to the recognition of deferred tax assets arising from unused tax losses. And specifically, given the uncertainty in the business environment that's going on at the moment, the recognition of deferred tax asset from unused tax losses, there is the need to make sure that there is this appropriately supporting evidence to warrant the recognition. So, for example, needing to make sure that the appropriate nature of the evidence to support the recognition is disclosed within the financial statement. So for example, it's actually explaining in detail the basis to support the future profitability of the company should be disclosed. Now, within their report as well, they list out the focus areas that they will be prioritising for next year. And not particularly unsurprisingly, they have said that they're going to focus on climate-related risks and also the continuing judgments and estimation uncertainties that are going on in relation to the COVID-19 pandemic. Now, these two themes we will flow through for the rest of this session so you'll see those all coming through. Now, I've picked up on two key consistent messages that the FRC have raised in this annual review report, but also their other reports as well. And firstly, the first consistent point is the need to really take a stand back when you're giving your disclosures and make sure that the overarching disclosure objectives within each standard, as well as that expressed within IAS 1, are met. So it's not the use of having a tick box approach. Have I disclosed these particular requirements? It's, do the financial statements, do the disclosures give the transparency and the understandability for users and investors in relation to a particular area of transaction. And finally, consistency between the front end and the back end. It is something which I do see when I review financial statements, that you read something within the front end, that there's a particular strategic focus area or a new product being launched or a new business area, for example, that's being moved into within the strategy. But then within the financial statements, there's no mention of this within the reporting. So it's really, really important to make sure that the two mirror up, and particularly in terms of materiality as well. So, for example, we do often see that something isn't deemed to be material, and so it's not disclosed within the financial statements, but there is a lot of emphasis and narrative being placed on it within the front end. So that's another key message throughout all of the FRC's reports. So just looking a little bit more at some of those details in relation to judgments and estimates, this is the #1 topic area of questions that the FRC have raised, and this has been the third year running as well. Just to give a little bit more detail about actually what needs to be disclosed and actually what the requirements say in this area. Again, it's very important to sort of understand really why judgments and estimates are so important, given the extent of the uncertainty and also the lack of the sort of the consensus view on the future impact of COVID-19 on the economy. Then there is this need for much more significantly enhanced disclosures around all the judgments that the directors and the sources of estimation uncertainty that have been applied when preparing the financial statements. In terms of the judgments, there needs to be disclosed the ones that have the most significant effects on the amounts in the financial statements. Most significant effects, it's not a defined term within IFRS, but I like to think of it as, would that judgment have changed the nature of the information that's been provided, that's been disclosed? So, for example, does this investment need to be consolidated? Of course, if the answer was yes, or the answer was no, the information within the financial statements would look very different. When disclosing information about judgments, it needs to be specific. It needs to explain the reasons why the judgments were necessary, and also all the factors that have been considered. Now, comparing that to estimation uncertainty, the requirements here say that you must disclose estimation uncertainty where there is a significant risk of causing a material adjustment to the carrying amounts of the assets and liabilities within the next financial year. There's very much a focus on what's the impact going to be if an area of estimation changed. What impact would it be on the next financial year only? Where that is the case, we have to state the carrying amount of the asset and liability that is subject to that estimation uncertainty. Sometimes it's not always the full balance sheet disclosure amount that's disclosed. Sometimes it might be a portion of that. So that's why that disclosure is important. And then there's also the need to provide sensitivity on the assumptions that have been applied. Now, sometimes it seems obvious, but it is important for investors to give this sensitivity, because it actually provides them with information on the headroom about what assumptions and estimates need to change, that would then change the carrying amount of the assets and liabilities. Now, the FRC have said, if you want to give more information about estimation uncertainties, perhaps those that won't impact next year's carrying amounts, but they will impact future years, particularly, for example, in relation to climate reporting and climate related risks, then it's okay to give that additional information, but just make it clear and make a distinction between the timings that those estimation uncertainties will have on the financial statements. Moving on to the next area, which is APMs, Alternative Performance Measures. Now, this one is number 5 on the FRC's top 10 list of question areas, but it's becoming exceptionally more prevalent with the use of APMs in business reporting. And the FRC have responded to this by also producing a separate thematic review on APMs. Now, just as a reminder, the ESMA guidelines have been out there for a number of years, and they were specifically designed for companies who report, who are listed on a regulated market within the EEA. However, since the UK have left the EU, the FRC have announced that they do expect UK companies to continue to apply the ESMA guidelines because they are consistent with UK legislation and ultimately they codify best practice. So there isn't any reason not to apply them. From an IAS 1 perspective, there are specific guidelines and requirements within IAS 1 that mirror the ESMA guidelines as well. So these ESMA guidelines, whilst they specifically are aimed at front-end reporting within IAS 1 have the equivalent principles for the financial statements reporting. So ultimately, all the same principles apply throughout the entire annual report. So what are these key points? Well, firstly, undue prominence, to avoid undue prominence given to the APMs over any IFRS measures. Now, in practice, this is a difficult one and it's a fine line. But ultimately, the APMs shouldn't be given more authority over the IFRS measures. So, for example, saying something like this APM gives a more truer reflection of a company's performance compared to the IFRS measure, for example. And particularly when you're presenting them on the face of the income statement, making sure that the APM measure, for example, if you're looking at EBITDA, that's quite a popular one, it's not visually got more prominence than other measures, for example, the total profit for the year. The other points are making sure that there is always clear and accurate definitions and explanations provided, clearly explaining what the APM is, defining it, and also explaining the purpose of it. So why is this APM being used? Why is it deemed to be useful information for investors and users? There's also the need to provide reconciliations and calculations for all APMs. So, for example, if you were reporting an APM that was, say, operating profit, operating profit margin, making sure that it's clearly defined and users are therefore able to reconcile the operating profit margin. You would, for example, have revenue disclosed in your income statement, and you'd also have the operating profit. Sorry, it's not a requirement under IFRS 1, but you can disclose your operating profit on the face of the income statement, and then users would be able to clearly reconcile the figures back to the operating profit margin figure that you are disclosing there. The final point is in relation to non-recurring items. The message here is really just to be careful when you are disclosing non-recurring items. A lot of companies tend to state that unusual items or exceptional items are those that are deemed to be one-off, but then there are adjustments made continuously year on year for those one-off transactions. So it's just really making sure that if you do want to adjust for them, just be clear and don't maybe give them a misleading label that they're recurring, that they're non-recurring when they're actually, perhaps they do recur year on year. I've pulled out some interesting statistics and data actually from the FRC's thematic review. I do find these graphs quite interesting. Well, the first one looks at the most common adjustments to profit and loss in relation to APMs. And as you can see, restructuring charges is top of the list. And then there are other ones down there that I think you would expect. You've got profit and loss on disposal of investments, impairments. But some of them there, you can see the amortization of acquired intangibles and share-based payments. Those ones the FRC have sort of picked up and sort of said, well, you know, these are IFRS determined figures. They perhaps question why they are being adjusted for when, for example, in relation to share-based payments, you know, they appear that does appear to be a valid cost of a business and ultimately relieves company of a cash expense. So if you do adjust for it, then explain the rationale behind the adjustment for them. And the same logic really applies with amortization of acquired intangibles, because on one hand, you know, the acquired intangibles that you have acquired as part of a business combination is contributing to the enterprise value of the ongoing business, and therefore why is it deemed necessary for the amortization of those acquired intangibles to be adjusted for. Now the other graph is a really interesting one. So of the 20 companies that were sampled, only one of those actually resulted in an IFRS profit that was greater than the adjusted profit, whereas everybody else gave much more of a favourable position from the adjusted APMs. So what's the message there is that absolutely, you know, absolutely fine to do this, but just make sure that when you're adjusting for a gain that gives you a favourable position, you should always the next year adjust for a loss as well, even if it results in an unfavourable position. So it's the need to be consistent and adjust for gains as well as losses. So just moving on now to provisions. Why is this review particularly important that the FRC did? Again, they did a separate thematic review on provisions. The thing about provisions and contingent liabilities is particularly important because it provides investors and other stakeholders with information about potential obligations for a company and the details of uncertainties relating to companies' exposures, particularly based on forward-looking information. So it does provide investors with a lot more insight into the future-looking information that management have applied when preparing the financial statements. So really here, the key messages are the need to disclose quantitative information about expected timing. A lot of companies tend to be quite vague in this area. So for example, if you have got a property related provision, disclosures tend to be quite limited, stating things like, oh, the uncertainty or the expected cash flows will be paid over the term of the lease. Well, it's actually about being much more specific and saying the expected timing of the cash flows will be within the first years or right at the end of the 15-year lease, for example. So being more specific. The FRC have also said that companies need to explain the nature of underlying outflows for property-related provisions, and this is particularly coming out of IFRS 16. So, for example, if you've got an onerous lease, the lease costs will now be included within the lease liability as part of IFRS 16, but the disclosure for any remaining onerous lease provisions needs to specifically say, well, what are the remaining costs included in this provision? So, for example, any service costs relating to those property provisions. Ultimately, the message here is that companies tend to be a bit limited on the disclosure they provide in relation to provisions, and there's much more need to be more specific, explain the assumptions, explain the uncertainty, whether that uncertainty relates to the timing of cash outflows or whether it relates to the actual uncertainty on the measurement of the cash flows. Be more clear and be more specific. Moving on now to going concern. This is again, the FRC did a separate thematic review on going concern as well. Now, going concern in general, the level of disclosures and detail that companies provided has absolutely gone through the roof. It's much more clear, it's much more better. And obviously that's as a result of the COVID pandemic. And unfortunately, this uncertainty is continuing. So again, the points here are needing to make sure that the inputs and assumptions are clear and they are consistent with any assumptions that are applied elsewhere in the financial statement. So for example, in relation to impairment review testing. Just a reminder also that the period of assessment, it can be longer than the minimum being at least 12 months from the date when the financial statements were authorised. It can be longer if that's deemed to be the appropriate assessment basis for your business. 17% of companies that the FRC looked at did use an 18-month period from the balance sheet date, for example. And then finally, there is the need to remember to provide the detail on a qualitative and a quantitative basis. And as you can see on the slide there, what I've done is I've picked up on the 4 key areas that the FRC have highlighted to remember to give detail. If your business had reliance on government support, to disclose around that. If your business has a particular short-term liquidity issue or focus, to talk about covenants and headroom that you've got within the borrowings. Talk about facilities that are drawn as well as those that haven't been drawn down, because that does give an indication to investors of the headroom that's available. You know, ultimately, the overall aim here is needing to provide investors and stakeholders with information on how the company is managing to maintain its solvency and liquidity over the short term, the medium term and the long term. And then the final area is looking at climate related risks. And I'm looking at this specifically from a financial statement perspective. We'll talk more about the financial reporting later. But here really the need is to make sure that there is consistency between the front end and the back end. So where we talk about, for example, if we talk about the use of electric vehicles within the front end of the business, then that is reflected within the financial statement end. For example, does that mean that the useful life of diesel vehicles needs to be reduced because you are expecting the use of electric vehicles to come within the business in X year number of time, for example. So it's making sure you've got that consistency. Importantly, provide negative confirmation. If you deem that climate related risk is just not a significant risk for the business, that's absolutely fine, and disclose that, because it does give that confidence to investors that the issue has been thought of and it's therefore concluded that it's not an issue. The expectation for investors are very high in this area, and as I said before, there is a need to take that step back and think, are investors expecting me to give it disclosure information on this? Yes, there might not be a tick box approach that we need to go through, but if it is an issue for our business, then disclose that information and really, really be clear on what that is. Now, the FRC and the ISB have published documents that are actually very, very useful guides to talk about the in-depth of how climate-related matters might impact your financial statements. For example, in the use of when you're carrying out an impairment review, if you've got an expectation that you're going to have increased environmental costs, or you're going to have reduced sales from the non-eco-friendly products that you are selling, for example, then they should be taken into account in the impairment and disclosed as such. And then very finally, the last thing I just wanted to include for completeness, if nothing else, these are the standards that have come in for this year. So if from your perspective, from the board's perspective, these are the standards that have come in under IFRS that you might be impacting your business. We've got the interest rate benchmark reform, we've got the COVID related rent concessions, and the IFRIC have brought out some decisions in relation to SaaS arrangements, that's software as a service arrangements, demand deposits and electronic transfers. And from an FRS 102 perspective, you can see there that the interest rate benchmark reform and the COVID-19 related rent concessions, that also applies to FS 102 reporters as well. So that was everything that I wanted to say on the first section in relation to financial statements reporting. So at this point, I'd like to bring in Anthony and Andrew to the discussions. And we're going to move on to the next main area, of the key area that we're going to be talking about, which is the government's proposals within the audit reform white paper. Now, there's an awful lot going on in that paper, and I'm certainly not going to be able to cover it all. But some of the key issues are they have got a corporate reporting impact area in relation to enhanced disclosures and reporting obligations in relation to dividends and distributable reserves. There's a requirement for a new resilience statement, and ultimately they're looking to widen the definition of PIEs to cover AIM companies, large private companies, and even some public companies as well. So enough talking from me. Anthony, I'm going to start off with you, please. Can you give us an update, please, on the most talked about areas and those that have created the most debate, and where you think things are going at this stage? You're on, Anthony, you're on mute.
Yeah, excellent. No, thanks, Jessica. I mean, I suppose the first question is, when are we expecting to hear from the government on how they're planning to take their proposals forward? To the best of our knowledge, that's likely to be early in the new year. And there's two things to look at: when they publish the statement on how they've responded to the consultation, which closed in July. And secondly, is there a parliamentary slot for the legislation, particularly to set up ARGA, the new regulator, in the next session of Parliament. So we're expecting that announcement early in the new year, as I mentioned. Following on from that then is lots of speculation around, always hard to tell how authoritative some of it is. There was an article in the Times on Friday which seemed to suggest they had an idea of likely direction. That was suggesting that there would be some extra PIEs. I think the general feeling is probably not the largest group the government suggested, which would be 2,000 more private companies, perhaps more around the 1,000. But then there's also other businesses, as you highlighted, particularly of importance to us today, which AIM companies come within the scope. So we're waiting on that issue. So what's going to be the scope? I think on some of the key issues, then areas such as managed shared audit would be likely, which the Times article suggested could be coming, would be likely to be mainly FTSE 350, would be likely to be FTSE 350. So for the ones that would affect AIM and smaller listed companies, clearly a new approach to internal controls and exactly what nature it takes. That article suggested that directors might be asked to indicate that the internal controls were working effectively each year. Now, I think, again, it depends. Is that just financial reporting? Does it go more widely? And to what extent does it veer towards a UK SOX, or does it mainly focus on the code? Some feeling that it might be mainly at the code end of things, but that's yet to be decided. I mean, other key areas then, as you've highlighted, resilience statement, proposal that it would be going out 5 years in the white paper rather than 3 years, as most companies have been doing, and greater, and possibly for some companies an important issue, greater clarity on what are the distributable profits and greater disclosure on them. So quite a range of issues, as well as more focus on fraud. And I suppose, just in closing on this part, Jessica, I suppose it's just to say, worthwhile companies actually saying, regardless of what's coming, are there some things in the white paper that would be useful for me to look at? So I think, for example, is the audit committee checking internal controls effectiveness thoroughly enough? You may want to look at that. I think there's some feeling that the codes, that there hasn't been a huge amount of detailed checking on controls there. So that would be one area. Also, resilience. Could you be doing more in resilience? Is that an area worth looking at? And what areas, at least for your internal purposes at the moment, what areas are you having subject to any additional assurance? Do you want to review that? So I think well worth boards, Jessica, actually not just waiting for everything to happen, but saying proactively, are there some things in the white paper that are good for business anyway that would be worth looking at?
Okay, thank you. So 3 key areas there that boards can sort of look at now and not necessarily just wait. So just picking up on one of those then, Andrew, with regards to the resilience statement, can you just give us a quick update on the possible direction of travel here on the resilience statement, please?
Certainly. So just to sort of clarify a bit, Anthony mentioned a 5-year period there. That only covers your short and medium term elements. So we've got essentially Kingman said the viability statement, and for that matter, a fair amount of going concern hasn't really delivered. You mentioned some of the going concern points with regard to COVID earlier. So what Kingman said was viability, well, scrap it or fix it. And the fixes proposed are to require reporting on 3 periods. The short period is essentially your going concern period, 1 to 2 years, but with better disclosure. So improve the disclosure, look more at scenarios, look more at stress tests, and give us better information about what they are. In the medium term, and the medium term, not the long term, the medium term runs out at least 5 years. So companies are expected to tell readers about scenarios they considered. The white paper has suggested 2 reverse stress tests. We don't know whether that one's going to go through, but let's see. So looking at a downside scenario and how far can you run that downside scenario before the company breaks, essentially, before it goes becomes insolvent or ceases to be able to operate. And that could produce some uncomfortable disclosures. So it'll be interesting to see exactly how the proposals go here. And then finally, it's a resilience statement. It's not just a solvency statement. And I think it's really important to these proposals being useful that it goes beyond just, will the company still be in existence and is it going to go bust? But how the long term is going to look. What's the period beyond 5 years? That needs to be business model focused and look what might need to change in the future. What does climate change do, for instance? What's an oil company going to do when carbon emissions from burning fuel are either illegal or require in place carbon capture? What do companies which provide subsidiary equipment to a gas or oil burning plant, like say steam production, heating equipment, what do they do as that equipment's phased out? Will their business model survive that? What are their plans for dealing with it? How far, taking off climate change, how far will internet shopping go? And what's the minimum retail estate that has to be preserved to actually make your business function? And personally, I think this is probably the most interesting element of the proposals, but it's also the most difficult. If we look back at Lawrence's comments, I suppose, is it a burden? Well, the burden is having to think about it, making sure your board actually does think about it. And that's, I think, the direction of the government's proposals. Actually look towards the future of the company. Don't just run steadily into a dead end and fall off a cliff or run into the wall at the end of it. Having that wall having been visible for the last 5 years.
Yeah, absolutely. Thank you. Anthony, one of the last Thursday, I noticed that the FRC published a report. It was called the Creating Positive Culture, Opportunities and Challenges, and it builds a lot on the FRC's work of promoting corporate culture. Do you think that this is a report that's worth a read for companies before the year end?
Yeah, no, I think it's definitely worth a read. It's a slightly interesting report in the sense it's not got a checklist of things to do, but it's rather more a discussion. I think actually it's the type of report that it'd be good for all board members to look at and then have a discussion on what they think they're doing well and what they might improve. Just picking out a couple of areas that I noticed and thought were quite good. I mean, I thought one area was they looked at what were the challenges and barriers to, companies having an effective culture, and they came up with issues of subcultures in boards or in companies, issues around M&As and the linked issue of that, cultural heritage, where there's been a long-standing way of doing things, and possibly, say you can imagine if you're an oil and gas company. It may have been you were a frontiers company and that was really what was respected. And now if you're trying to change your model, it could be new things you need to be focusing on in the business. So I think quite a few areas looking at the barriers and trying to make sure you're overcoming any barriers and challenges. But I think they also set out, making sure you look at culture in a broad way, that you've got good data, that you do site visits. I think an interesting issue around how you do site visits, with COVID, and whether you should be putting something else in their place at the moment, but also the importance of deep dives. And I think deep dives in culture really, would want to stress the importance of those. So I think a really interesting report and well worth a look, but not a checklist, more a discussion document for the board.
Okay. Moving on to our next area is in relation to risk reporting. So there we go. There's a lot of that's a very high level overview. There's a lot of requirements out there in relation to reporting on our risks, but the FRC have brought out 2 reports this year, one on risks, uncertainty, opportunities and scenarios, and then the other one on section 172 reporting. So I'm going to start off by asking Anthony a question again. From a corporate governance perspective, are there any what are the 3 or 4 big issues coming out here, please, from your perspective, from the FRC?
Yeah, and there's also this report, and there's also the report, on the governance report that they produce every year. I mean, in terms of risk, I think one of the interesting issues they bring out in their governance report is, have businesses changed their risk assessment enough following COVID? They think there's been some improvement in risk reporting, but I think the key question is, have you really focused on how your risks have changed, as a result of COVID? And I guess COVID and the world changing generally, so you could be looking at, issues such as cybersecurity, I guess, could be, an important issue, and the whole approach to dealing with talent management, actually, I think, with it being hard to recruit people and things. So I think really one headline issue, Jessica, would be to say, have you adjusted your risks properly, the assessment, the scoring for changes from COVID?
Okay, thank you. Angie, from your perspective then, from the more the narrative reporting perspective, what do you think are the messages coming out of these reports?
I think on the first one, probably consistency, specificity and evolution. So don't dismiss a risk in one place in the report and then still include it in principal risks. If you've got risk related metrics, then talk to them, mention them in the reporting on risks, make the impact of risks to the business clear. So not just generic boilerplate as, exchange rates might affect us, or we're exposed to economic downturns, but we are more or less exposed to your economic downturn than other companies in this area or in the economy generally. We're particularly sensitive, or exchange rates are important because this proportion of our turnover comes from, is denominated in dollars and our costs are in sterling, not just a generic bad stuff might happen, something that actually ties it into something that actually has happened or might happen to the business or could be predicted to happen to the business. So take out the boilerplate, give an idea of extent of impact, and also think about how risks have changed over time. What's coming up the agenda, what's going back down again. You can't have everything getting more important because not all risks can be principal. Then on section 172 reports, I think get some decisions in there. So again, it's illustrate things. You've got your engagement, you've talked to people. What did you do about it? How was that considered? You don't have to take, or you don't have to enact everybody's view, and you've got to recognize that there are going to be some negatives. If you have to shut part of the business down, that's not much fun for the people who are working in it. So what have you done about it? What have you done to help them? Have you taken that into account? There are others that are more nuanced, where it's not necessarily clear what the positives and negatives are, but discuss them. Have some case studies there. But don't be scared about looking at what the negatives were. The best reporting we've seen over COVID particularly was the reporting that discussed openly that there was a negative in taking some of these actions, and that impacted some of the stakeholders. And then what did the company do about it?
You mentioned there the principal risks, and Anthony mentioned cyber risk as well. So just putting aside climate just for this moment, what do you think are the new and emerging risks that companies need to sort of be putting on their agenda maybe for this year and going into 2022?
So the obvious ones, I suppose, are supply chain issues. So how do Brexit or COVID or a general concern about logistics and national security, particularly in IT or semiconductor markets, affect the business? Those aren't going away. And then, sorry, I've sort of mentioned IT already, but cyber risk more generally, how might that affect your business? So, you know, it's coming further up the agenda. It's becoming more critical for more businesses. If something goes horribly wrong there, how does it affect your business? What are your backup plans? And have you got some near misses you could tell something about? I think, Anthony, you were talking the other day about a report from the National Cybersecurity Centre, presented by someone who didn't quite call themselves Q, but I think it was something along those lines.
Yeah, and I think that's no, and we can include that report on the webpage if people are interested. And I think that last point also, Andrew, you made just before that on, you know, talking about some of the challenges. You brought it out, I think, Jessica, on the, you know, general financial, on the financial reporting. I think the FRC are quite keen to see, you know, reports both front end and the back end that do have a balanced flavour in them, and, you know, recognizing that the front end as well is meant to be, you know, fair, balanced and understandable. So making sure, you know, some of the challenges come out, you know, is also important. I mean, maybe on a slightly different but related topic, Jessica, on the corporate governance reporting paper they brought out in November, I think one of the key things they're saying is, as well as saying risk management, as I mentioned, they didn't think as many changes had occurred as they thought. They've also, the other area coming out is nominations committee and a general feeling that boards could report better. But I think the underlying question is there more boards should be doing around the work of the nominations committee, but around areas like board succession, board appointments, and also the related area of board effectiveness, what gets disclosed after board effectiveness reviews, and diversity and inclusion, where they feel, you know, processes are disclosed, but not so much, you know, link into strategy. So I think that whole area around board and people is another area to be focusing on in thinking about, are we doing enough and are we reporting it well?
As your balance of the people that you're looking at tied in, I suppose, Anthony. So yeah, there's a call for an expert on cybersecurity and an expert on climate change, and you can't have an expert on everything. So what are the most important ones, and can you integrate that to have a functioning board? Yeah,
and I think that's a very interesting point, Andrew. I think both, yeah, because I think on, you know, technology, you'll probably have somebody who's good in one area, but may be able to ask, you know, informed questions more than other members of the board in another area. And so I think, you know, that's an important issue, you know, to look at. But also maybe in some of these areas, you know, I can remember a dinner we hosted, you know, a while back, obviously, when events were still being held on, you know, and somebody said, does it have to be a board member? Could it be you have a special advisor or an advisory group that helps you on some of these issues? So I think also for the board to say, have we got enough expertise? But some, you know, often, you know, you need a lot of it in the boardroom itself, but some of it could be in an advisory role as well.
Okay. That's a useful tip. The fourth area is in relation to climate reporting that we wanted to talk about, and there's an incredible raft of requirements out there in legislation, which is all a little bit disjointed. It's been sort of appearing over a number of years. And in the dark boxes that you can see on the screen there, we've got the new TCFD disclosure requirements coming in for premium listed companies from this year, and we've got the new legislation that was announced by the government just before COP26 as well, that's going to be impacting large AIM and private companies as well. So, Andrew, can I ask you? Goodness me, this is the $1 million question, isn't it? Where do you think companies really need to be focusing for 2021, and how can they start to prepare for all of this?
Well, I think the key point is that for 2021, you're not focusing on 2021 as far as climate change is concerned. You're focusing on preparing for the future. So looking further out about where climate change, or actually not just climate change, but any of these long-term effects are going to affect you. What supplies are going to become more expensive? What customers are going to have to change what they do? How's that going to hit you? And not just looking, at 1 year, 2 years, 3 years, but further out. Not asking every company to produce a complete financial model of the future and really detailed, financially planned out scenarios, but if you have a transition plan, what do you have to do to achieve it? If you don't have a transition plan next, where are the areas you're going to have to look? What's most important? And then having done that, what are the systems you need to build to monitor that, to understand what's going on? So financial systems, fairly mature now, the controls are there. Non-financial systems, far less mature. We've got the equivalent of maybe half a dozen lines in the cash flow at the moment. We need to build an integrated system that looks like, and not precisely like, because your balance sheet is probably not going to balance, but that looks like the cash flow, the balance sheet, and the P&L. Get an accruals concept. Build activity-based costing to see what your social impacts are by product, to be able to understand what the variances are. So not just, oh, it's gone up, something must have happened, but why has it gone up? What parts of the business have driven it? Was it an external cause that drove that impact? Are we still on target to achieve our plan? And is the purpose, I mean, one of the points that's made across a number of these reports is corporate purpose. So is the purpose of the company consistent with what you're saying? Are your customers on board with your purpose?
Do you have, I mean, I've just shown all the raft of different reporting requirements. Do you have any practical advice then on how best to sort of report on the climate reporting requirements?
Well, shall we pick on TCFD and tie things into that to start with, I suppose. Essentially, it's going to be about integration. So few companies already been doing something on TCFD. What are we going to bring in there that we've already got? Well, some of the existing infrastructure is going to be useful there, SECR, for instance, and your strategy and your business model. So you're already supposed to be reporting on business model if you're a listed company, or if you're a pie. There are going to be more pies, they're going to have to report on business model as well. What are the resources you need? So how does it tie that in? Are some of those resources related to climate? Then how are you measuring them? So you've got SECR that's currently nominally in the director's report. Bring it in to your TCFD discussion, because that's your measurement at the moment. Are there other measurements that have to be brought in there as well? There are bits of company legislation, and when I'm checking out the reports for listed companies that come across my desk, then I am bound, I'm afraid, to say that you've done this bit in the wrong place. It's got to be in the strategic report rather than the director's report, or possibly vice versa. But there are mechanisms for putting things in the same place. It's not an insuperable problem. So bring things together, don't splat them all over the report in unconnected parts, integrate them.
So then the last area, which is obviously related to climate reporting, is sort of the wider sustainability reporting. And we've had an incredible amount going on this year, sort of behind the scenes, and it's a highly rapidly developing area. We've got the IFRS Foundation looking at international sustainability standards, and we've got the government announcing their green finance road to sustainability investment policy just before COP26 as well. So Andrew, can you sort of update us? This is in the briefest way as you can. So update us on where we are in the UK and the rest of the world in relation to wider sustainability.
Yeah, I take your point on brevity there, Jessica. We could go on at some length about this, but okay. So TCFD, in there for premium listed companies, coming for standard listed companies, coming for unlisted companies, the larger end of them. Exactly what the threshold is, well, actually, no, sorry, TCFD, I think, has gone through the Commons today, so that's looking fairly certain. That set of requirements is going to be in 2023 for the larger end of unlisted companies and for AIM companies, or for most of the larger AIM companies anyway. The sustainability disclosure regime, which the government has said it's going to do, isn't there yet, but it's going to be in. It'll tie us to the ISSB standards. So the IASB has created an international sustainability board. That sustainability board is in the process of producing standards. You can look at their initial draft at the moment. It's a much more discursive thing than accounting standards. So it's looking at strategy and plans. Those standards are going to be in place. They will be in place within the next few years for the UK, for the larger companies in the UK. Quite how far down, not yet clear yet, but it'll be there. Green taxonomy, that's a list of what counts as green and what counts as brown. In there in Europe, UK is still thinking about it. There are certainly things worth thinking about because a lot of the economy isn't clearly green or isn't clearly brown. So what do we do with the ones in between? You're going to need some sort of scoring mechanism if you're going to include them. So there's a lot coming. There's a raft of legislation. But to do that, you've got to decide what's important to the company, what you're going to measure, how you're going to measure it. There'll be some things that you're just told you've got to do this, but you've got to start thinking strategically about what systems you need to build those systems for how they're going to work for the business in the future.
Right, so the focus really for this year end is not about the doing, it's about the strategic and thinking what's coming and what do we need to be doing to get ready. Is that right?
Laying out the plans, building the foundations.
Right. Fantastic. And then just finally, Anthony, just I know that Mazars have joined forces with EcoData to create a practical guide to help board members and leadership sort of navigate their sustainability journey. Can you just tell us briefly about this guide?
Yeah, no, thanks, Jessica. And again, the guide will be on the website. The guide really aims to get companies to take a proper focus on how they can really embed sustainability within their business, looking at sustainability from an environmental, a social and a financial point of view. The guide recognises that companies are at different stages of development, but it sets out some key principles if you're going to genuinely embed it, around making sure it's linked to your purpose, it's in your strategy, you're taking account of it in your culture, you're measuring it properly. So, really just encourage, companies to, if they'd like to have a look at the guide, and to see if there's some things they'll be doing and other things they'll probably be able to develop. And so just encouraging that approach. And I suppose really in just closing on this, just to say, to see it as an area of opportunity as well as challenge, not just to see the challenges, but also to see the opportunities that, creating a sustainable business really does offer.
Yeah, that's a lovely thing to end on there. That let's see the positives in this. So thank you very much, Anthony and Andrew. So just very quickly, just the closing remarks of today's webinar. On your screen, you can see now that the FRC, they've announced their reviews and priority sectors for next year. So particularly if you're operating in those priority sectors, that means that you might have more of an increased risk of your financial statements being selected by the FRC for a review. And then just to end, really, I think the key messages here is that we are still facing the ongoing uncertainty from the COVID pandemic, with Omicron unfortunately coming now much more to our forefront, and obviously restrictions are being tightened this week. We have got this supply chain risk issues still going on as a result of Brexit, and of course COP26 really has highlighted that climate related effects are increasingly being seen as the most important issue of our time. And I think the thing is, the future remains uncertain, and it might be that there is this pervasive impact on your accounts that you do need to reflect when you're year-end reporting. Ultimately, users of accounts, they will be looking for information on how directors have assessed the implications of their events on businesses and how they have responded. And the financial statements, it's not just a tick box approach. It's much more than that, as ever. I know I've been saying it for a number of years, but it's not a tick box approach at all. It's about providing useful, transparent, and complete financial statements. So thank you ever so much for listening, everybody. I don't believe we've got any, let me just double check the chat box, the question and answer box. I don't believe we've got any questions for us today. So thank you all for listening. We hope you enjoy the webinar, and we'll no doubt see you shortly. Thank you very much.